Evaluation of terms and conditions. When evaluating terms and conditions, investors should consider loan duration, prepayment penalties, repayment schedules, and additional fees or charges. By comparing lenders, investors can identify loans with terms that align with their investment goals and financial preferences. For example, investors may prioritize loans with flexible repayment options or minimal fees to maximize their financial flexibility and minimize costs over the loan term. Also, comparing terms and conditions allows investors to avoid pitfalls and choose loans that offer the greatest benefits and protections for their investment portfolio. Understanding and comparing terms and conditions is such an important step in the loan selection process. This enables investors to make informed decisions and optimize their long-term financial outcomes. The fifth thing to consider is the different financing solutions. When comparing financing solutions, investors can consider factors such as the loan terms, interest rates, repayment schedules, and even eligibility criteria. For example, some investors may prefer traditional mortgages with fixed interest rates and long repayment terms. In contrast, others may opt for adjustable rate mortgages or interest-only loans to minimize initial costs or take advantage of potential interest rate fluctuations. Investors may explore alternative financing options such as private lending, crowdfunding, or seller financing to diversify their funding sources and access unique opportunities in the marketplace. By comparing loan rates and exploring different financing solutions, investors can make informed decisions that align with their investment objectives and financial circumstances. The sixth thing to consider is risk analysis and management. Comparing loan rates allows investors to assess the impact of interest rate changes on their investment returns and cash flow. Investors can develop strategies to mitigate potential risk and safeguard their financial future by considering various scenarios and conducting risk analysis. Comparing loan rates enables investors to identify lenders that offer favorable terms, such as flexible repayment options or even loan modification programs. This can help manage risk during challenging economic conditions or even unexpected events. Conducting risk analysis and management through comparing loan rates is really important for investors to make informed decisions and also to make sure that they have a stable and resilient investment portfolio in the long term. And the seventh and last thing to consider is market trends. You need to stay informed about market trends. This is important for investors to make informed decisions and to adapt to changing market conditions. By comparing loan rates from different lenders, investors can gauge how lenders respond to shifts in interest rates, economic indicators, and regulatory changes. This information allows investors to anticipate market trends and adjust their investment strategies accordingly. Comparing loan rates helps investors identify emerging trends in lending practices, such as changes in underwriting criteria or the introduction of new loan products. This insight enables investors to stay ahead of the curve and capitalize on opportunities that arise in the market. Comparing loan rates is such an important tool for investors to stay informed, make smarter investment decisions, and achieve long-term success in their real estate ventures. So what is our takeaway from these 7 things to consider? Comparing investment property loan rates is essential for maximizing your returns and minimizing risks.